Good. All right, let's start. Thank you for the opportunity to talk at the Ride at Home event today. My name is Alex from Bank Montreal, and so we're going to talk about it. First, actually, I want to ask a few questions from the audience. Have you been told or seen the following? Clients with low credit bureau score would not be considered for commercial lending, or maybe raise your hands. No. Have you ever seen or heard or been told? No special programs in commercial lending. 100% financing is not possible at any of the big five banks. Startup companies cannot be financed without CSBFL. Of course, that term, if you're not familiar with it, we will talk about it. That's more for government guaranteed small business loans. But anyone? No? Okay. No tangible asset, no commercial loan. What I will say is, those are all the things that I've heard when I was not in commercial banking. So that's all the things. In fact, you will see all of the above is actually possible in commercial banking. There are multiple ways we can help clients. Second part, bank only does senior debt. First of all, what is senior debt? It's loans on the first charge or first ranking.
First claim on asset. Right?
First claim, right? But are banks only interested in lending to first charge?
It's about the risk, capital risk. We can't take more than that.
We could do senior debt, mezzanine debt. We could also do equity. So that's something that I didn't even know about until I came to corporate. Lending is the only thing bank does, and typically it's low loan to value. Actually, no. We actually do M&A advisory. Right now, I'm actually talking to one of my mid-market client that's being approached by one of the major players in the industry for close to $100 million. And he's like, I don't know what to do with this. You're being my bank, can you help me with it? That is something we can also do. Asset-based lending, up to 90% financing on your inventory. For those of you who knows inventory financing, typically that's normally 30 to 50% of it, but we can go up to 90% with, of course, certain terms and conditions. Specialty financing, sales financing, MIG financing. Some of you who are mortgage brokers who may or may not have a MIG book or private lending book, we could actually finance that. And we've actually financed that up until December last year. Now, obviously, because of real estate market uncertainties, they're not looking at any new ones at this point. Trade finance, supply chain finance. That's something that I'm recently exploring a little bit more, but in Asia, there's a lot more of those, PO financing and all that. That's also something that corporate finance could help. LC discounting, similar to that. Equipment financing, truck financing, that's more of tangible asset, but not something that it doesn't move. It actually moves around. There's still a solution for that. Dealership finance, that's also something very different in the sense that, you know, all the new car dealerships, all the floor plan financing, all the vehicles in there, did they all buy it themselves? No, it's all financed somewhere. So I'm starting this with a picture. Sure, you've all heard this before. Give me one firm spot on which to stand, and I should move the earth. What does that mean? Leverage. But the question is, why do people want to leverage? Many of the smaller business-sized clients that we talk to never understand the necessity to leverage, nor wanted to leverage. But why? Why do people want to leverage? By leveraging, my thought is, you are able to do things that you couldn't have done with the funds that you or your family can come up with, right? Why do we borrow a mortgage to buy a house? It's very difficult to come up with $1 million to cash to buy a house these days. That's what you do. But on the flip side, why would the lender or the bank or lender in general want to lend you the money? We want to see that you have the ability to pay for it and the stability of the cash flow. Because the money is not going to be repaid over in 1 month. It's going to be paid over 3, 5, 10, 20, 25 years, or even longer in some cases. But if the stability is not there, then how could the bank or the lender give you the loan? So that's the two sides of the story, right? We all, many of us want to borrow, but could we get the right arrangement for financing? And also, do we have what it takes to borrow the money that we want? How am I doing for time? Good? Okay. I actually shortened my slides significantly for this event, because normally my slides is much, much longer. So remember earlier we talked about CSBFL. What is that? Canada Small Business Financing Program, or CSBFL, which means the last word means lending. Eligibility, it's a little bit small, hopefully you can all see it. And actually I brought some pamphlets available to distribute about this later on if you want it. Eligibility, small business loans or startup operating companies with revenues of $10 million or less. Financing, we can provide up to $1 million per borrower. And it could be $500,000 on the equipment and leaseholds, and of which $150,000 could be used maximum for operating line of credit. So this is something new compared to what it was, I think, about a year ago. This is much more reflective of the current inflationary world of the equipment and everything else. And also, but why is there another difference? Because you see, $500,000 or 150, but on top it says 1 million. Because you could also use this program to purchase real estate, owner-occupied real estate. So what that means is, well, actually, we'll define that in the next slide. But basically, it's a piece of real estate for your company to use, not for rental purpose. What kind of product can we use? Term loans and operating line of credit, equipment, leasehold, vehicles, and the day-to-day operating expenses, fees. So this is the interesting part. Interest rate at prime plus 3. So prime today is 6.7%. Plus 3 is 9.7. Plus, there's a 2% government registration fee. So if you look at that, 9.7 plus 2, you're looking at 11.7%. That's quite significant. And I might even say that's closer to private lending, right? And also for line of credit, the maximum interest rate they would charge is prime plus 5%. Now, obviously, that varies depending on the risk profile of the individual client. And there's also a government website, because this is actually supported by the government to help small business. And you can all go to that website, canada.ca/CSBFP, for more details. Now, obviously, why would people want to borrow money for small business loans? Now, some of those you may say, well, for McDonald's, it probably costs way more than $1 million or $500,000 to buy a franchise. But some of those, or even Canadian Tire, you may say, but some of the smaller ones, and also BMO have about 30 authorized programs that can or doesn't necessarily even need to use the small business programs, and we can help you with that. So basically, if you want to start a business, or if you want to buy an existing business, and you couldn't get the right financing arrangement, this is what something BMO could help you with. Are we too finished? All right, next one. Real estate financing defined. On the same piece of property, for example, this property that we're sitting today, it could be defined 3 different ways. 1, owner occupied. What does it mean? Right at home, for example, buys this property and uses it for their own purpose. That's considered owner occupied. It doesn't mean they have to live in it, like in the residential world, but you are using, the operating company is using it. Investor owned. So for example, I am a landlord. I bought this piece of property and I rent it to Right at Home. For me, in front of the bank, this is a rental property, so that's called investor owned. Construction. So for example, if I were the landlord, 20 years ago before this was built, I bought this property, this piece of land, and I'm building it for my own purpose. If Right at Home we're building it, then that becomes owner-occupied construction property. What BMO could do, and this is also very interesting with my fellow speakers, BMO's focus is actually on owner-occupied. So we do a little bit on the investor-owned, but not as much, and I would even say for the larger rental property, that's not our forte or even what we want to focus on. In construction, we can do, however, it's only on owner-occupied only. Commercial real estate, some of you may want to take a picture of it. It's really more of, based on different property types, what are the things that we like and what are the things that we look for. I'll go to the column on the right first. Just like anyone buying any real estate, we look at location, the appraisal, age of the building, building condition, Environmental. Environmental is something perhaps we can have another discussion or session on, because this is very specialized, and that in itself could take hours to talk about. But just for this purpose, know that there's phase 1, 2, and 3. 1 is basically look at historical, 2 is you do some actual physical inspections, and 3 is when 2 identify you have issues, now you're cleaning it up. So that's something that you typically didn't have to deal with in the residential world, but in commercial, for any of the larger size deals, we do have to look at. Going back to stable operating income, stable operating cash flow. Remember what I said earlier about leverage? This is what's important, right? You're borrowing money. Any lender says, yes, I'm happy to lend it to you, but what are the cash flow that you have coming from this business or coming from all your repayment sources available that can be used to be repayable? That's why. If building is partly rental, because when we look at a building, so for example, Right Home were to own the whole condo building block today, they're using part of it, and if Right Home were to have the cash flow available to pay for the whole loan, the whole thing is considered owner occupied. And why do I make that distinction? Because for owner occupied buildings, even for office condos, for owner occupied, maximum loan to value is much better. Because as long as the main operating company does not need to rely on outside rental to support the building, the whole thing becomes owner occupied, and I can have much higher loan to value as compared to a pure rental perspective. And obviously we talk about it. We can look at construction loans for owner occupied buildings. That's about that. One other thing I want to note is you will see that max percentage is different by different property type. What does that mean? That to me means the bank feels different property type has different inherent risk perspective. Because from the bank perspective, my job is to lend out money. But why do I want to lend out more money for property A than property B? Why? Because the risk is different. So look at that, and you will see that medical buildings is higher, loan to value, some are lower, but there's some variations in between. So I'll go for that. That's basically the gist of my presentation today. A little bit about BMO. Best commercial bank in Canada, 8 years in a row, 2015 to 2020. All the awards, accolades, all there. The first bank in Canada started in 1817, so even before Canada was formed. We are the 8th largest bank in North America and the 4th largest in North America in terms of commercial banking. So in terms of size, we're definitely up there. That was the total assets as of last annual report. I think now we have $1.1 trillion in assets because we just recently bought a bank in California, Bank of the West, and that closed in February. Yeah, that's about that. A little bit about myself, 17th year in working with BMO. A little bit of the awards that I've won, I've done well for myself. Definitely thinking I'm the kind of person that wants to think outside the box to help the client. So I'm not going to turn down any smaller opportunities just because dollar amount is not there, but also I'm always happy for that first call. Prior to commercial banking, I've also done call center jobs, so mortgage fund manager and also retail personal banker. So that's about it. There's other things we can talk about, but I'll leave that for the Q&As. So, thank you.
Thank you so much. Maybe we could take a couple of questions now, if anyone has a question. Yeah, back.
Yes.
Yeah, you mentioned there's conditions on medical buildings and mixed use, but they have 100% loan to value.
Yeah.
So could you just give some of those examples of conditions?
So first of all, that is based on the fact that it's owner occupied. So for example, if you are a dentist, if you are a family doctor, and you are buying that building for your own use, not when you are a landlord buying the same piece of property but renting it to the medical professional. So in that perspective, yes, we will need to look at the medical professionals' track record, their financials, right? Their relative experience in Canada and also internationally as well, right? So using that to go back to project what is the cash flow that can be used to support this mortgage, and also evaluate what is the stability of that cash flow in terms of the longer period of time. So yes, it's up to 100%, but it also depends on all the other things as well.
And then just following up, owner occupied typically, if it's a mixed use, I'm assuming it's low rise, I'm assuming it's something like a dentist wants to have like a office and maybe like a.
There's no limitations on that.
So owner occupied for a mixed use high rise, like what would be an example of a property that would
I just said, so for example, I mean, using this extreme example, if Ryder Homes cash flow could support this whole building, aggregate, right?
Yeah.
Whatever that mortgage number is, if they could support, then we could consider the whole thing as owner occupied because they are using one unit,
Okay, yeah.
right? So that's a definition. Yes,
Can you talk more about the asset-based lending or ignoring the corporate, or that could be another representation in the future? The
I
corporate
think
banking.
it's more fitting for another session because that's a whole discussion in
Different.
itself, yeah.
I have a
Looking forward
quick-
to that.
Yeah. Sorry, Alex, first of all, thank you so much. It was really nice. Just have a quick question on the same thing the gentleman asked. So I think in terms of the maximum value, you go for the LTV. So how about your cash flow? So when you say the stable cash flow, do you have a particular limit to it that, I mean, it should meet to your requirement, or you look for the 6 years in the past? Because, for example, rental markets are increasing now. And if we feel of for any recession going forward, so then how do you calculate and how much this 80 to 85%, 80 to 100% goes to take care of the risks which are coming in future, not in the past? I mean,
So your question was more on the rental properties, because you were focusing
no,
on
for
the
example,
rental
even from the
income.
bank side as a lender.
Yes, but your question is on the rental side, on the rental income, right? It's the changing of the rental income. Yes?
Yeah, because I want to understand how would you do it for the owner, because owner is not paying anything. It's just like for his own use, right?
Yes.
So from the bank's perspective, how would you calculate that? Just on the basis of because there is no rent, right?
Yes, so let me answer this in two ways, right? So if it were a rental and if it were a owner-occupied building for the same property, right? So for owner-occupied, we look at a track record of the past financial statements, normally last 3 years. And we use that to sensitize what it looks like the future is going to be, right? For example, if you are, call it, in e-commerce, you did very well in the last 2 years. But will your trajectory be the same going forward? Probably it's not going to be like this. It's probably a much slower pace than what it was before. That's how we normalize cash flows, right? Normalize EBITDA for owner-occupied buildings or owner-occupied operations, right? For rentals, it's less than that, but we also do look at the impact of the higher interest rate, which we will talk about, because everyone saw that, right? Significant interest rate rises since last summer, and how that is going to impact the tenant, because the tenant's business also may be impacted, but also how is the higher interest rate going to impact the landlord, right? Because there are some deals that will be underwater that they won't be able to pay the mortgage with the much higher rate today, right? But also, bear in mind, most of the clients in commercial, they have a fixed rate mortgage for a certain period of time. So the question is, or the $1 million question is, how long this higher rate environment is going to be, and hopefully it doesn't impact all the clients when they are up for renewal.
Thank you so much.
Thanks so much, Alex Chang. Appreciate
Yes.
it.